Okay, welcome back. In this lecture, we're going to cover Chapter 7, where Chapter 7 is largely a continuation of a similar discussion that we started in Chapter 6, which is what are the main things that managers can focus on in order to generate value from the firm. And those main things, they originate from the key value driver formula. Right? So the key value driver formula has four main growth or value creators or effectors. And the two prominent ones that we're going to talk about, and what we talked about last week was one of them, which was return on invested capital. And the one that we're going to talk about today is the growth rate of the cash flows. Okay, so these are the two most effective and most valuable ways for managers to create value, to create lasting value. And we're going to talk about here some strategies to create value by focusing on revenue growth. Now, this is not going to be as effective a strategy as focusing on return, and that's for a very simple reason. And we talked about it a little bit in the early lecture of Chapter 2, and that's because focusing on return is always value creating, meaning if we can come up with a strategy, and a sustainable one at that increases the return for the firm, then the firm is always going to create value. Okay? So there is never a downside to focusing on return. Focusing on growth is a little more nuanced, right? Remember that within the key value driver formula, growth appears in both the numerator and the denominator. So there is not a clear impact, meaning if I increase growth, it is not necessarily a good thing for the firm, right? So there is a caveat. And that nuance means that strategies that focus on growth have a little bit more difficult time establishing value for the firm, because growth only creates value when the return on invested capital exceeds the cost of that capital. Okay, so ROIC has to be greater than WACC for an increase in growth or any growth at all to create value for the firm. So that nuance means that growth strategies are a little bit more difficult to implement and a little bit less valuable for the firm. So the way we're going to work this lecture is we'll sort of break it down into four parts. First, we'll talk about the three main components of growth. In other words, just like we talked about with return, we're going to talk about the different strategies and where growth can come from, how valuable those strategies are going to be. We'll do a little bit of talking about the difficulty of sustaining growth. So we'll spend some more time here looking at the empirical data than we did in the return section, because the empirical data on growth is a lot more mixed, and we want to at least take more caution into asking managers to undertake strategies that focus on growth, given that the data doesn't support all of those strategies. Okay. So again, here's the key value driver formula, just so that we can sort of look at how growth plays into it, right? Again, there are four main components of growth. NOPLAT, which is the net operating profit of the firm. G, which is the growth rate in that net operating profit or revenue. ROIC, which is the return on invested capital, and the weighted average cost of capital, how much it costs us to raise money. Right? And you can see that for the other three inputs in this formula, the effect is clear. If NOPLAT goes up, the denominator is larger, value is increased. So if we generate more operating profit, then we're good to go. If the weighted average cost of capital goes down, then the denominator gets smaller. Again, we're better off. ROIC goes up, the numerator gets larger. Again, we're creating value. But G is on both sides. It's in the numerator and the denominator. So if we have a change in G, it's going to have a differential impact. And again, we look at this growth return matrix from Chapter 2, and we can see that differential impact. We can see that growth only creates value if return is higher than the weighted average cost of capital. Okay, so this is a really, really important function for us. And it's why strategies that focus on growth are much more difficult to implement. Okay. So what our question here is, should managers focus on growth, right? That's one of the things we're going to try and talk about. What are the kinds of strategies that do generate growth? and how can managers focus on those? And then which ones of these strategies are actually going to be effective and create value in the long term, right? Because again, look at this formula and think about what we are trying to determine when we talk about strategies for return and growth, right? Nothing in this formula is affected by time. So all of these numbers here, all of these inputs, they are assuming that that the firm keeps those inputs the same for the life of the firm, right? ROIC here needs to be the same. So whatever assumption we make about the firm's return has got to be stable. Now, when we looked at the empirical data in the last chapter for chapter 6 for return, we actually were pretty comforted by that data because we saw that returns for firms are fairly stable across time. Okay, so that firms that had high return for the next 15, 20 years. And firms that had low returns for the next 15 or 20 years. So when we're talking about running this model and then making an assumption that return is going to be stable for 20 years, we're comforted by the fact that that seems to be the case. We need to address that same concern for G, the growth rate, right? Because growth rates are also here assumed to be the same forever, right? So when I put G, I don't put G for year 1 and then have a different G for year 2 and a different G for year 3. I just say the growth rate in cash flows is 5%. So what we want to do is look at effective strategies or look at strategies, talk about how effective they are, talk about how sustainable they are, then try to look at the data and try to see which strategies are sustainable and effective. And hopefully that helps us guide decision making for managers and or if we're the manager, it helps us guide our own decision making. Okay? So growth is just as important as return on invested capital. It's just not always as clear which methods of growth or which strategies to increase growth are effective in the way that it is pretty relatively clear which strategies are effective for creating better returns. Okay, so here are the 3 main components of growth. In other words, these are the 3 ways that we think companies can affect their growth in a reasonable way. Okay? And this is based on the data, right? So these are, we have a big sample of companies that McKinsey has worked with. Again, samples companies that McKinsey has advised strategies to increase their growth, things like that. What they're looking at is once the firm undertakes a strategy in one of these categories, how does that actually create growth and revenue for the firm? Okay? So the first one that we'll talk about is called portfolio momentum. And this is what we call organic revenue growth. Organic meaning the growth is created by actually generating more sales, more revenue. So we're bringing in customers that we didn't have before. That's what we mean by organic growth, right? And we'll contrast that with inorganic growth, which is down in the last category, where inorganic growth means we didn't get more customers to buy our product. We just bought another firm. And so our revenue grew, but it wasn't because we got new customers. It was because we just bought somebody else's customers. Okay? So organic revenue growth, our portfolio momentum is made up of organic revenue growth, and it is enjoyed by the firm because the firm has expanded the market. Right? And so this just means portfolio momentum means whatever we were selling, whatever market we were engaged in has gotten larger. And so there are more customers in the market now, and the firm is enjoying revenue growth because we're selling more to all these new customers. Okay? The second kind of growth, or the second sort of characteristic of growth is called market share performance. And market share performance is also organic revenue growth. In other words, we're bringing in new customers to buy more of our product, and so revenue is growing because of that. But this is just because, not because the market is getting bigger, but because our slice of the market is getting bigger, right? Our piece of pizza is getting larger, but the pizza has stayed the same size. So we are capturing our growth by capturing some of the revenue from our competitors. Okay? And then the last one, the last sort of main component of growth is via a merger or an acquisition, meaning we don't, and again, this is inorganic growth. We're not bringing in convincing new customers to buy our product. We're simply buying someone else's customers. So this is sort of like market share performance. right? The pie may or may not be getting any bigger. We can't say, but let's say the pie doesn't get any bigger. And we don't capture other people's growth by convincing them to buy our product. We just say, hey, listen, we're just going to buy the other person's slice of the pie. And now we have 2 slices of pie. But that isn't organic growth. It's inorganic growth. Okay, so this is just revenue growth via a merger, which is a combination of firms, or an acquisition, which is a purchase of a firm. Right? And those 2 terms have become somewhat interchangeable over the last 10, 15 years. So just sort of keep that in mind if you're ever paying attention to the financial news. Now, what we want to think about and what we want to ask ourselves is which one of these 3 components of growth is the most effective and which one is going to be the most sustainable. In other words, where should we direct a manager's focus? Should we say, listen, the best way for you to grow the revenues of your firm is to try and generate some portfolio momentum? Or should you try to go after your competitors' market share? Or should you just buy some more firms? Just get bigger inorganically by using some of the firm's cash flow, or maybe a loan, or maybe selling some equity, and just buy other firms. And then you increase your revenue growth and you increase value just simply by getting bigger through acquisition. Now, the answer is not 100% clear-cut. But the evidence is strongly supportive that the best way to generate revenue growth that is sustainable is via portfolio momentum. Okay, so we'll talk about some strategies to generate portfolio momentum, but essentially, what we want to see, what we observe in practice, is that the most sustainable and the most valuable types of revenue growth are those that come about because the firm is growing the market. And that means new customers are coming in organically. We're adding revenue by selling to new customers, and everybody's happy. The second best then is via mergers and acquisitions. So this has a much more mixed method, but it is certainly a viable way to generate revenue growth. But certainly you can see here that it is not nearly as effective in terms of generating growth for firms. Not even half as effective as trying to generate portfolio momentum. And then finally, way, way, way down at the bottom, generating almost no actual revenue growth is maybe a surprising for you. It's surprising to lots of managers, and that is market share performance, right? So capturing your competitors' market share, despite it being sort of maybe the first thing you thought of, and certainly a popular tactic among management teams and among firms, has historically generated very, very little of firms' actual revenue growth.